Jason Attew, President and CEO of Royalties. Royalties is a senior leading royalty and streaming company with senior quality assets in the best jurisdictions in the globe.
Modest with it. How are you, Jason?
Very good, thank you.
Good to see you here. Are you enjoying yourself?
It's brilliant. Running a royalty company in this market is just fabulous.
Well, if you've got producers in the portfolio, yes, absolutely. In fact, just had one of your compatriots here,
Yes.
Sean Aruzen,
Yes.
talking about Caribou. Obviously not a producer yet, but good signals from them.
You've had some very positive developments. So you just talked to them, so you know it's a project is rare. I mean, it's a permitted project in British Columbia. Really, all they need from a de-risking perspective now is get their financing in order. And as we were talking about earlier, we're quite supportive. We're not only we're a 24.4% shareholder, but we also, more importantly, have a 5% NSR on their project. And Sean probably talked to you about the timeline to get the asset into production. 2027 is where they think they can start breaking ground, or actually sooner than that, producing 2027. And so again, it's a great catalyst for our company. And those gold equivalent ounces sit outside currently of our 5-year outlook. So again, think that there's some really positive things that not only Cisco Development has done, but some of our other partner companies have done over the course of the last few months, that we think that, again, when we do our refreshed outlook come February, there's a number of assets that we think will actually fall into our 5-year outlook, given the positive momentum with these companies.
Right. Let's talk balance sheet, okay?
Yes.
Because you've obviously had some debt
Yes.
on the balance sheet. People are interested in what's happening with that, what's happened with that, I should say, and revenue profile. Just give us a kind of sense of what that looks like.
Yeah, so I'll speak to it from a historic perspective. You're right. When I joined, it's about now 19 months ago, we had $300 million of debt. We're now in a net cash position. So really focused on not only the operating cash flow, but really laser focused on paying. We were relentless in paying back our debt, because again, we just really wanted to focus on delevering. That didn't mean that we weren't involved in transactions in 2024. We did in aggregate $300 million of transactions of committed capital, which represents about 10% of the overall $3 billion of royalty and streaming transactions that were done. And we represent about 5% of the aggregate market cap. We're a mid-tier royalty and streaming company. Our market cap is $5 billion now, and obviously had a nice lift given where the commodity complex has gone. So our balance sheet, we're actually right now in a net cash position, which is really, really good. From our perspective, it allows us to have the financial flexibility and capacity to do accretive deals on behalf for our shareholders go forward.
Right. And let's talk about business plan. Let's talk about the strategy.
Yes.
I think we've talked in the past about other players in the market, and there's like some people's kind of sitting back, some people paying down debt.
Yes.
Some people are active in some of these bids
Yes.
that are out there. How do you kind of play this market?
Yeah.
Gold doing what it's doing, everyone gets excited, maybe too excited, maybe you overpay.
Yeah.
How do you view it?
So we've seen this cycle before, haven't
Yeah.
we not? So look, from our perspective, we've got to just continue to remain disciplined. We are involved in every process that happens out there. I mean, we are significant players, so anything that Franco or Wheaton Precious, Royal Gold is looking at, we also get a look at. Obviously, they have a cost of capital advantage, and so we just have to be really, really disciplined. There is momentum in the market right now.
Yeah.
We do, and we're very honest with our operating partners or the opportunities that we do see. We price everything off consensus, and consensus long-term gold, because that is our primary product right now. We're about 94% precious, most of that being gold, 67% being gold, but 20 odd percent, 25% in silver. So we're looking at a lot of precious transactions. You did mention the commodity complex has done very well. And so the long-term commodity for gold anyway is around $2,400. We are very straight up front with, again, anything that we might be in terms of a finance package, that's how we price our deals. Obviously, people on the other side want price on spot. Again, we really just don't know for assets, especially that have durations 10, 15, 20 years, where the commodity complex is going to be at that time. And if we end up, because of that discipline, if we end up missing a few deals, so be it. Again, no one really has tomorrow's paper today. We don't have a crystal ball as to where. I think gold is going to have a very constructive tape for some time, but we're in this for putting long-term assets in our portfolio. We just don't know exactly where this. So we'll exhibit discipline. We will only do deals that are above our own hurdle rates, based on, again, the consensus price deck.
So when can you used an interesting phrase in there a second ago, which is that cost of capital to some of the bigger boys, the Wheatons of this world. If they're sitting on big cash piles, the money's cheap. If you're borrowing, it's a bit more expensive, right? So where do you think you need to get to be able to kind of compete for the type of profiles that you make across swords? Because and you've got to take a view on, as you just explained rather eloquently, the market and the commodity price, and etc. But at some point, an asset may be worth more to you than them, and therefore the cost of money equation really falls away.
Yeah. So another really good question. So again, 2024 we generated, from a cash flow of operations perspective, about $160 million US. This year, again, as long as the commodities stay where they're at, we're looking at 40% above that. So, 220, 230 million of operating cash flow. Again, we have very low fixed costs. There's 25 full-time employees within our company. It's not any different with any royalty or streaming company. So the opportunities that we look at everything. I mean, there was $1 billion transaction from IAMGOLD's Colte Lake just printed. What was just 7-8 days ago. We certainly had an interest and a look as a Canadian asset. It fits our profile. But again, that's we have to be disciplined around our cost of capital. So our sweet spot, to answer your question, given where we're net cash, we're generating 200 plus million a year in cash flow from operations. Our sweet spot really for transactions are between 50 million US and 500 million US.
Okay.
We can stretch in specific opportunities, but we again have to, the only way we're going to make money for our shareholders is if we actually do transactions that meet our hurdle rate.
So basically, you're going to compete on a cash basis going forward. Does that work better for you?
Well, we have significant liquidity, so cash is accumulating on our balance sheet now.
Yeah.
In addition to being net cash, we have a partnership or an operating asset in Australia called CSA Mine. Mac Copper's now received a friendly offer from Harmony Gold. We also had an equity stake in that, about 4 million shares. So we're actually getting another $50 million US from that transaction. Plus, again, as I mentioned, all the cash that we're generating. Yeah. So our preference certainly was to deploy our cash. But we do also have a revolving credit facility. Yeah. A revolving credit. I mean, it's not that the cost of that is not that expensive. We're talking 5%. But our preference would be to redeploy our cash that we're generating into accretive acquisitions.
Right. You need to have a very super optimistic view on gold price to break those rules, right?
We don't. Again, we don't speculate on gold price. That's why we use consensus.
Which is what, 22 at the moment?
It's about $2,400 US long term right now. Okay. I mean, it's obviously higher for the first 2 years and then drops down 3-4 years out. But again, we're in the business of if you get these things right, you can actually make asymmetric returns for your shareholders. Yeah. If the commodity does roll over, at least we're guaranteed a return above our cost of capital. Yeah. And if it increases or continues it with a constructive tape that it has, I mean, that's just very good for our shareholders in particular. And we're seeing very good deals. The opportunity set and the pipeline's quite robust right now.
Right. Look at us talking about mining as if nothing ever went wrong. Isn't that great? Let's talk about that. How do you factor in the kind of the risk management portion?
So I would say we've got an exceptional team that prices risk. We've got, for example, we have an individual on our team. He's just been across some iconic assets. He's been a mine manager of Tasiast. He's been a mine manager of Fruta del Norte, two of the most iconic producing gold mines out there. He also had some experience working with a royalty company. So he really helps us take a look at assets if they're cash flowing currently, or if they're going through expansion and or development. He helps working hand in glove with a very experienced geologist that we have to really help us price risk. Because as you're absolutely right, mining is a very tough business. You can't always predict what's going to happen, but we have to do our best to understand the asset firstly. And so our filters would work through, the first filter that we do have is around geography. We take great pride in, we're peer leading in terms of the geologic and geographic profile that we have. 80% of our assets and cash flow and our NAV sits in Canada, the US, and Australia, which again is very different to the rest of our peers. So you take some of that geopolitical risk out, and then you really have to focus on the technical, which again, we have a team that can really tear apart assets and hopefully price risk accordingly, that provides our shareholders a very good return. In addition, we're seeing how we actually go, because I talked a little bit about guidance earlier, but how we think about our guidance when we put it out is we're probabilistic around, we don't obviously take the operating partners necessarily their production forecast or their forecast to heart. We do our own work, and we make discounts or adjustments, haircuts as we see is required. Plus, then we factor in things. I mean, I've been in the business 30 years. We were never factoring, when we were putting budgets together, we were never factoring things such as climate change. We know what's going on right now with all the fires in Canada, and that's going to impact a bunch of businesses. And so we put those factors in as well before we actually come out with a guidance figure, both for the 1 year and the 5-year outlook.
Right. Okay. Business models are evolving and changing. You kind of touched on some of the maybe upside because of this thing, where in a gold price environment like this, some of the developers are accelerating a production profile.
Yeah.
I'm not saying they're going to cut to the end game, the big game, but they're having starter pits, they're having starter packages where it's an anti-dilutory movement because money's not available. Prices are good, margins will be good, and it may kind of facilitate a kind of different growth profile for them moving forward, which can be self-financed. So, are you the beneficiary of any of these sorts of moves yet, and if it were maybe in the near term?
So I would say we're certainly the beneficiary of, let's say, gold equivalent ounces that we had in our models put out 7-8 years from now, because a lot of that, based on the factors that you're talking about, will get accelerated.
And cut-off grades, obviously.
Cut-off grades, given where the commodity price is. But I would also say what was happening specifically with some of the U.S. assets is the permitting, and some of the Canadian assets as well. I mean, in Canada, it really is just, I would say, politicians saying that they're looking at streamlining. We haven't seen anything effectuated as yet. But in the U.S., certainly there's more evidence that projects are going to be streamlined. A lot of the bureaucracy around duplicative processes are being eliminated. We, in fact, have an asset that's not in our guidance. It's called Spring Valley. It's an asset, a very nice asset in Nevada that the Waterton Group purchased a number of years ago. And the expectation is actually going to get his environmental approval in the next 6 weeks. The record of decision is going to come by August 11th. And we have a very nice royalty there that the profile of this asset, once it's up and producing, is around 300,000 ounces a year. And so we have a very nice royalty there that will generate for us anywhere between 6,000 and 7,000 gold equivalent ounces. Again, that was completely out of our thought and forecast up until some of the positive developments around permits. Obviously, there's some capital available now too, that companies that are in the development stage can finish off studies. They can look at the trade-offs that you're talking about, going smaller scale to really bootstrap bigger operations, which didn't exist a year ago.
Yeah.
So we're seeing it being quite constructive, quite positive for our asset base.
Right. And what about this? Well, we just had one. Caribou. We talked about it at the beginning. Do you think more of these brownfield sites will now be kind of jolted into life again?
Should be.
They make sense now,
Yes.
don't they? These prices.
No, they absolutely should be, and
Is that good for you? I guess
it is good for
yeah.
us.
Yeah.
It is certainly good for look, we obviously have assets. We have 195 assets in our portfolio, and only 22 of them are producing right now. So we've got a long string of optionality of the assets that you're exactly talking about. Um, and so we'll be a benefactor of those certainly going forward for sure.
Right. You must, in a way, you must be distraught at the price of precious metals at the moment, because you're going to have to do a lot more work. Disturbing you from your beach, because of these 995 projects, there'll be some that you'll profile a certain way at 1650 gold, right? Which, as gold has moved through the phases, they take on a very different look in terms of timing, in terms of margin, in terms of scale of operation, etc. So it's exciting, right?
Yeah. There's no question.
Because I always wonder, like, with these portfolios, big portfolios, like, you got to kind of cull them occasionally, and so there's some that you may have been thinking, maybe eventually need to let that go. Now you're like, well, actually, no, we're going to keep up a bunch more of those.
You're absolutely on point, especially the margin point that you made, because prior, again, it's all based on economics and the access to capital, and if you can demonstrate you're making very good margin, and arguably some of the developers in this commodity complex, I mean, the hedging, the H word is not a dirty word anymore, because again, it does make sense as the paybacks, we were talking payback earlier.
Yeah.
The paybacks are actually getting very reasonable, some inside a couple of years for some big significant projects. And again, the way that they can secure their cash flows is doing a little bit of hedging, which I do think it makes sense. But that then obviously would bring not only the investors, but hopefully some of the other financiers, and we're obviously a financier for high quality assets. And as I said, what our first filter is around jurisdiction, in high quality jurisdictions with teams that we think have the best technical acumen. So not only we have all this great optionality, we're always on the hunt for more royalties and streams. And I would say from the opportunity set lens, just given where gold has gone versus copper or base, for example, half of our opportunities don't sit in primary gold mines. Half of them actually sit in copper base mines that have a secondary byproduct of gold or silver that haven't had the same appreciation from the commodity perspective, that still require some decent financing. And if they can sell off a byproduct, for example, in silver or gold, and have the piece in their capital stack or capital structure to finance a high quality expansion of a base metal asset and or a development base metal asset, it makes a lot of sense.
Right.
So we're doing a lot of work on those type of opportunities.
Right.
And we do think, and I do think personally, that copper in particular will have its day again soon. And we're just lining up everything. We're arguably those companies kind of loading the spring, and we want to be a benefactor. So again, we're attempting to finance a lot of those type of companies as well.
Interesting. And in terms of going forward, if you want to acquire with your cash, if that's the best use of capital, not share buybacks, is you got to be aiming for producers or near-term producers within a 2-year time frame, right? Because you got a portfolio of early development. So you don't need more of those.
So I would say we've expanded it to 5 years.
5.
So again, mine commissioning takes longer. Permits usually take longer. So our lens is 5 years.
So your return profile changes dramatically if you do that, right?
It does change.
Is that the new reality at the moment?
Well, that's, again, when I came in, there was really no time horizon. They were financing assets that could have been 10, 15 years out. But given the long tail of optionality that we have, the minimum that we'll actually look at is if we starting receiving a return within 5 years of our investment. And so far that's worked out very well. We actually I know it's a small transaction, but we picked up a silver stream in Nevada. Again, the theme is all about jurisdictions, at a very good asset called South Railroad that Orla Mining, I don't know if you're talking to them this week, Orla Mining will be developing, and that will go into production in 2027. So we have the silver stream, which we purchased from Orion Mine Finance for $13 million. I'm intimately familiar with South Railroad because I used to actually run the company at one point. I think that's when we first met. And so the feasibility study there was from 2022. there's going to be an updated feasibility study. So it's 3 years old, and they've been doing a lot of drilling since then. And so we think we've actually made a very smart investment to get all the silver when the asset's in producing, and what Orla says is 2027. So that kind of gives you a lens. We make an investment in 2025, we start seeing a return in 2027, 2028. That's really the blueprint of how we're trying to do transactions go forward.
So I often say this to CEOs who've just been through what we've been through, which is a tough cycle. We're not out of it, but it kind of feels green shoot-ish territory. Yes. What have you learnt? Because there's a whole bunch of guys who've had their ass handed to them, right? And they've learned the hard way that life's not easy, and you don't, and it's unpredictable, and mining's tough, and lots of different things like that. But for you guys, what's changed in your thinking?
So I think I'll reiterate, in the business for 30 years, seen cycles, and it doesn't seem to change very often. When we're in this robust commodity cycle, it is all about capital discipline and capital allocation. Unfortunately, we're probably going to see some companies just do things that are not wise, and they'll have to take big write-downs in a few years. Hopefully not with the commodity complex. That is potentially a theme that's going to happen. So we just have to be laser focused on our capital allocation discipline. From the royalty and streaming side sector, again, we're doing very, very, very well. All of us. I mean, we're all generating very good cash margin at these commodity prices. And so I always like to tell my team about, I love sports, and I love sports analogies. And I always like to go back to one of the sports figures that I think is always notable. His name's Christian Horner, who is the Red Bull principal of Formula One.
Yeah,
and he says,
Spice Girl, more importantly.
Yes, he's Mr. Ginger Spice, 100%. But he said, in the Formula One, and it totally applies to royalty and streams, in this sector, there are winners and wankers, and you definitely don't want to be a wanker. And so we're again, from a capital allocation perspective, we'll be disciplined, because we definitely don't want to end up being a wanker when we do a look back, when I'm talking to you 3, 4, 5 years from now.
Good to see you, man.
Yeah, good to see you.